Hi, everyone, and welcome to a special installment of Barron's Live. It's Ali, Coram, and David Saito Chung here of Investors Business Daily. And this month, we would like to focus our talk on lessons we can learn from the late IBD founder, Bill O'Neill, known for how he was able to handle some of the market's biggest winners in such a unique way, really being able to pinpoint those winners and buy and sell them at the right time. So pretty incredible learnings that we want to share here today, Dave.
Oh, absolutely. Good morning to you, and just welcome to the audience. Thank you so much for tuning in.
Absolutely. So, Dave, to kick us off, we're going to be digging into 5 examples of Bill O'Neill's biggest winners throughout the last couple of decades or more. We're going to rewind the clock, go back on the calendar many years and progress through time. But let's lay the foundation first to keep in mind as we're looking at these charts, what we really can learn. What are those core lessons to share and to keep in mind as we peel back the layers with some examples?
Oh, absolutely. As you said, Ali, the backbone of today's webinar will be focused on the charts, but not only on the charts. It will really, we hope, help unveil so-called secrets behind how Bill O'Neill, who passed in late May at the age of 90, how he discovered these amazing winners that produced triple-digit percentage gains in a relatively short period of time. These are the examples are not swing trades. They're not 1 month or 2 month trades, but these lasted 52 to 52 weeks to maybe a year and a half. And we're going to look at why he found these companies, what were the measures that were critical, in addition to then homing in on the buy points, the follow-on entry points, and eventually good sell signals.
Yeah. And so one of the key things is to buy what you know, right? There's so many opportunities all around us, couple of just current examples, even though they've been around for a little while. Apple, Google, these are products that we know and love and use every day and are widely used by all. Maybe even something more relevant to the current market is this prospect of artificial intelligence and so many companies trying to harness the power of AI. So we know that this is something that is impacting companies, individuals, the world even. So there are opportunities for us in terms of investments if we focus on buying what we know and what we're seeing around us.
Exactly. Hit it right on the nail there, Ali. And Bill often said in the newsroom or at webinars or in live shows, with IBD readers, that you're really looking for the companies that are going to change the way we work, the way we live, or the way we receive entertainment, and better our lives, make our lives more enjoyable. So we've selected 5 companies that reflect all of that. We just talked about that first of what I'd like to count as 7 points to help all of us on this webinar find those great Bill O'Neill stocks. So invest in what you know, invest in something that you see, experience, can buy, and really judge for yourself. Is this a great product or service? The second point is kind of related to that. Is like, look for something brand new, something that's either a new company with a brand new type of device or service based on technology, or is creating a new market. And in addition to new, which is one of those 7 principles for finding great IBD style stocks, you want the stocks to have maybe companies that are hitting new highs in the stock market, maybe new management that is really turning things around, and relatively new companies, ones that have gone public in the past 3 to 8 years. For a long time, I joined IBD in 1999, and we've always covered a lot of companies that were just recently public. It doesn't have to be like Kava, which went out in a market yesterday, right? It can be a while. It could be even a couple of years before the profits really start to come in for the investor, and the profits come in and the sales come in for the company. But investing in something new, that's the second very important point.
And we've got a couple more that we want to hit on before we dig into the examples. So,
Yeah.
companies with big markets, talk to us about the importance of that. We know
Yeah.
that strong earnings and sales growth are key to finding big winners, and you have to have a big addressable market if you're going to get that big booming sales growth figure or the earnings numbers too.
Exactly. Addressable market. In Wall Street, they have this uh, acronym called TAM, total addressable market. Look for those with giant total addressable markets, those that really can become a product, a service for the masses. So when we look at today's stocks, from Chrysler to Syntex to Price Club, which eventually became Costco, clearly they weren't fishing in some little small pond. They were really going for oceans of customers.
Right. And I guess if you really want to supercharge your performance, Dave, you
hmm
need to have a fairly concentrated portfolio. You're not going to get a triple digit gain if you're just in the S&P 500 or in tons and tons of stocks. So when Bill O'Neill found these sort of rare jewels, I guess you could
hmm
say, and had that conviction, he position sized appropriately to ride that wave.
Oh, well said, Allie. I think it's important for people to know, if they've never read or heard about Bill O'Neill. He was the youngest person in 1963 to buy a seat on the New York Stock Exchange. He was just only 30 years old. He was a broker at Hayden Stone in Los Angeles, and he couldn't get that successful by buying 100 stocks. He probably bought hundreds in stocks, and got out of ones that weren't working very well very quickly, cut his losses quickly. But basically, the profits of two major companies, Chrysler and Syntex, plus a short sale, helped him really stand out in 1962 to 63, and that produced the capital for him to then launch his own equity research company with an institutional brokerage, William O'Neill and Company, uh, first by buying that seat in 63 and then opening his company in Los Angeles in 65. So absolutely, you really have to think about putting as much money over time in your best winners. In other words, right, water your flowers. Don't water the weeds in your garden. You want to take those weeds out quickly, and allow, with the primary purchase and the secondary and the tertiary purchases, and holding at the appropriate time, allowing those gains to compound. We'll finish this point by saying that it was often Bill writing in a book, The Successful Investor, as well as saying on stage that diversification is usually an excuse for ignorance. So we don't mean putting all betting the ranch, so to speak, in just one stock all at once at the same time. But in general, we found through research that if you cut your losses appropriately, you can have 6 to 10 stocks in your portfolio and do very well in a good market.
Right. And this sort of leads into our next point very well, I think, because if you are going to stay on top of a mega winner,
hmm
you need to be able to do your research and focus. So that concentration is quite helpful, because with new products that are coming out, or CEO commentary, or really digging into the quarterly reports, it takes a lot of research
Right.
to build that conviction and to pinpoint the timing for these stocks as well. So
hmm
that those go hand in hand, I think.
Oh, totally, Ellie. And in terms of research, that involves looking at the chart. The chart is
Mhm.
really an evaluation of the stock's strength or weakness, the stock's action versus the S&P 500. And we're also looking at fundamental. Is the company growing fast now? Has it had a record of above average top and bottom line growth? And are the estimates going forward also rosy? Finally, what also made a game changer for William O'Neill and many, many thousands and thousands of other IBD readers is the acknowledgement that the real money moving is coming from the institutions. So fund managers, mutual funds, pensions, college endowments, foreign governments, sovereign wealth funds, on and on and on, banks, and investing departments of corporations. All of these institutions really can make or break a stock in the long run. So it's important to not just buy anything off the seat of your pants, or just impulsively. You have to prepare. Preparation is everything.
Great detail there. And speaking of details, that's the next point that we want to make. It's all about those little details. And Bill O'Neill taught us that, really dissecting the not only the fundamentals, but looking at the chart as well. Each price bar, where it closed, what the corresponding volume looked like, looking at the base structure week by week to uncover clues about where a stock is in its cycle. Does it have more room to run? Should you be taking profits? Should you be adding to the position? And really getting yourself familiar with all those little details is critical to being able to hold a stock for a big move.
Allie perfectly said. Could I be the host and you be the guest today?
No.
No. That was exactly what we're talking about in terms of details. Details regarding the growth of the company, products, its competition, knowing what risks are out there. If a company's been growing so fast and expectations on Wall Street get a little too overblown, well, you got to be ready for that. You got to be ready to respond to that or avoid that kind of sort of landmine, if you will. So clearly, details is a huge part of the game, and we're definitely going to cover some of these. We really hope that the examples will provide some nuggets of light bulb like moments for everyone here, so that they can make really great decisions going forward. And finally, the seventh tip, so let's review. The first one, obviously, buy what you know. Do your own research. Don't trust others. Check out a company. 2, get something new. 3, go for companies with big markets. 4, concentrate, not diversify. 5, do that research. 6, it's all about the details. But finally, the seventh one is, in a way, perhaps the most important one, Allie, and it is your ego and your personality. And it's very, very important to always stay humble and modest, and don't make decisions based on pride, because you can easily be shaken out of a great stock and you refuse out of pride or ego not to buy it back when the conditions are now much better, and let that stock wave goodbye to you as it goes up 100, 200, 300%. I can tell you, as an active investor myself, 110% committed to the IBD investing philosophy, that it's very important to understand that you're not going to be perfect on every buy, but you can be good. And part of that is dusting yourself off if the market shakes you out, and recognizing that the stock is really showing that promising sign of being a big winner.
Right. And I think on the other side of the coin, if you've done all the research and you have all the conviction, if the stock is breaking down, you can't force the stock to go higher. If you're wrong, you're wrong. You got to move aside. Don't let that ego get in the way. And that was Bill. He could change his mind instantly if he was presented with new information. And I think we can all learn from that, because I think if we free up our brain space, then, we'll be able to move on to the next big winner, instead of getting hung up on stocks that maybe were working in the past, but aren't working now.
Absolutely. Well, I'm eager to now look at some of those examples. How about you?
Let's do it. And we also are keeping in mind that a large portion of this audience is listening only. So as we go through these charts, we're really going to be painting the picture for you as we walk through these examples. So there are lessons to be learned, whether you are listening to this or watching this. So the first example that we want to be taking a look at, Dave, is
I
Chrysler.
think we're going to go with Chrysler, right? And 10 years ago, exactly 10 years ago, Bill O'Neill wrote a weekly column for the newspaper, How to Find America's Greatest Opportunities in the Stock Market. And he noted that Chrysler was his very first big winner, 1962. This stock, from its breakout point to its peak, up 215% in 52 weeks. You can see a lot of details here. This is exactly the chart that accompanied his short column in the newspaper. You might want to even take a screenshot if you like, because there's so much detail, as you can see, regarding how the stock set up its buy point. One thing that, as you look at it, let me just share a few uh, sort of background items. One is that Bill O'Neill noted that in early 62, the stock market broke on the government investigation into the mutual fund industry. So we had a bear market in early 62. But then, as you can see with Chrysler, it came back very nicely. I think 6 or 7 up weeks in heavy volume. And the heavy volume is, you can tell by those arrows pointing down at the volume bars. The blue volume bars are blue because the stock was up for the week. The red volume bars show that it was down. It turned out that the news was reported that the Love brothers, who were some very influential investors, they were accumulating Chrysler stock. William O'Neill bought the stock initially while it was forming that cup with handle, a base, a very, very important chart pattern that precedes the big moves. He sold into that weakness that formed a handle because that's when the Cuban Missile Crisis emerged. But an agreement was made. Russia sent back its missiles and decided not to deploy them in Cuba. And so you can see the stock then had a marvelous breakout. That's where the buy arrow is pointing to. Turns out that at the time, too, Chrysler was turning around its fundamentals, 2 straight quarters of big earnings. They had hired a new car designer with some winning designs that were winning in the market. And you can see after shakeout, stock closes mid-range, in heavy volume. That's what he liked to call heavy volume without further price progress down. And that was a sign that even though initially during that week in this weekly chart, Chrysler showed weakness, it proved strong in the end. That's very similar to what happens in bull markets. Weak opens and strong closes. So you can see after that breakout, 16 up weeks in a row, a flat base formed, which is generally a consolidation of gains, a decline of no more than 10 to 15%, and then another buy opportunity here. So if anything, this is a good example of a stock where you don't have to try to pick the low. Wait for the supply and demand equation to favor the long side. Finally, you can see there was a key sell signal near the initially around 50, where he notes that there was heavy volume with a price retracing the prior 2 weeks. Basically, it wasn't really making a lot of extra progress, even though the volume was escalating. So in other words, probably there was, just like at the end of the chart on the right-hand side, people selling into that strength, capitalizing on that kind of euphoric-like move after the stock had already tripled. So this was, as I said, a 215% gainer in exactly a year. And it came out of the birth of a new bull market. You can see,
Right.
yeah, I forgot to mention that. Yes, the follow through, which is our earliest and time tested signal that we likely are now taking off the bear market clothing and putting on the bull market clothing. And when that happens, the best stocks usually are ready to roll into new high ground, break out, and lead the market higher.
So great timing there to see a breakout on or around a follow through day, because our
Mhm.
research shows that it's often those names that are first to emerge are going to be the big winners. So it's important to be there and put a little money to work.
Exactly. 2 more quick points here. You see near the volume bars, there are two 2-for-1 split uh, symbols there. That shows that you don't have to necessarily buy a stock that's cheap. at the actual breakout, Chrysler, the pivot point, that pivotal breakout point was actually 58.5. So don't be scared about a stock that's trading in the triple digits or even in the quadruple digits. It's really the quality of the stock and the quality of the action that matters more. Finally, in that column, Bill noted that later he talked to Jerry Tsai. Jerry Tsai was a star fund manager at Fidelity. He eventually ran his own shop, and turns out Jerry Tsai also bought at that same breakout, and so did Gerald Loeb, one of Bill O'Neill's mentors, so to speak, a very, very famous stock and successful stockbroker who wrote The Battle for Investment Survival. They talked about Chrysler, and Gerald Loeb said, well, yeah, in fact, I bought shares right at that breakout too. So I think that helped reaffirmed Bill's thinking that, these patterns, which had existed before Chrysler's move, will continue on and on.
Mm-hmm. Yes, we still see them today. And the next example that we want to take a look at is Syntex. And this is really exemplifying that new
Mhm.
that we want to see in stocks. So tell
There we
us
go.
more,
Yeah.
Dave.
Yeah. The first company to successfully commercialize a birth control pill, Panama-based company. And here again, we have another Bill O'Neill column there. You can see that the early buy. I don't think he actually bought shares there. He just noted that within that very, very deep cup-like base, that could have been a good entry point. That's not where he bought it. In fact, he bought it when it emerged out of a very rare stock chart pattern, the high tight flag. And I don't have the How to Make Money in Stocks book next to me, but he actually highlighted in that book 6 other stocks that served as historical precedents before Syntex's great breakout in July 1963. Let me quickly rattle them off here. Bethlehem Steel in 1915, American Chain and Cable in 1935, E.L. Bruce in 1958, Zenith also in 1958, Universal Controls in November 1958, and then the most important precedent for Bill, it was Certainteed of January 61. So that's almost 50 years of history right there in 6 precedents. The point being that this is a rare chart pattern in which you see 100 to 120% gain, usually from a breakout point in about 4 to 8 weeks, followed by a very mild pullback of 10% to 25%, but generally between 10 to 19% over 1 or 2, 3, or 4 weeks. That produces the flag. The big 100% plus move produces the flagpole, and you can see it right there on Syntex's weekly chart. You can see too that there was only one down week, so the stock didn't want to take a break very long. You buy as soon as it clears the top of that flag, and then there's another note there from Bill: stock up more than 20% in less than 3 weeks, must hold for 8 full weeks. And the reason was he got shaken out of Certainteed during a 10% plus pullback after it came out of a strong base and ran up 20% in 3 weeks or less, and he saw Certainteed go up without him. So he took note of that, used that as a rule that he wrote down, and then applied that to Syntex.
Yeah, Dave. And regarding the high tight flag, just to emphasize the point here with that, or one of the points here with that. So this too, like Chrysler, was coming out of a bear market, early stages of a bull. We got that strong move up. So that seems very applicable for traders in today's market. We have come out of a bear market. We're in the early stages of a bull market here, or at least a very strong rally that we've seen over the last number of weeks here, month plus. And stocks are getting extended, but they could be setting up new potential entries in a matter of weeks, right?
Oh, exactly. That's right. So you want to look for follow-on entries. In the case of Syntex, this was a very, very rare high-tie flag emerging out of a very deep base after that difficult 1962 bear market. And You know, when I looked closely at Bill's book, How to Make Money in Stocks, and I looked at some of the examples, in fact, I found one Zenith, the color TV maker. Its high tie flag was very different from Syntex or from Taser or from Qualcomm or from Tesla. It didn't actually rise 100% as far as I could tell. I mean, it was less than that, but it was close, maybe 80, 90%. And then it pulled back very, very mildly, though, too. Sometimes you're going to have a stock, even in today's market, that doesn't fully meet the letter of the law, but it meets the spirit of the law. So you want to make sure that you have that kind of open-mindedness too, especially if you see that the stock has incredible relative strength and is already hitting new highs while others are sort of trying to figure out what to do.
hmm Another point to make here, I think, is about how this respected the 10-week moving average
Yes,
along
yes.
its big run, which is another sign of true leadership for a stock.
Totally right. You know, we've got that arrow looking at the shakeout finds support at the 10-week line. And one of the key rules that we have is that you can add shares to a primary position or even start your position on the first or second pullback to that 10-week line. But it's important that the market is in the early stages of a bull run. Also, I found I have a very old book called How to Use Data Graphs. These are the data graph product that Bill sold to institutional investors as research, how to use data graphs to make better stock market decisions. Uh, as he described why Syntex was a model stock for him, I want to highlight what he commented. I'm just going to read straight from the book here, but he said almost all institutions missed Syntex during its period of greatest advance. Stock was selling already near an all-time high and obviously appears too expensive. PE ratio too high, risky foreign corporation, a rumor that women get breast cancer from the pill. 10 years later, 10 years later after this move, 80 mutual funds and banks own the company. And you can see, you know, this was a marvelous 451% move in 26 weeks. He sold at the top because he wanted to wait long enough for the long-term capital gains tax to kick in, which was at the time 6 months, not a year. And you can see at that as that happened at the very top alley, you have a sell signal called a climax top. That happens when you have a gain of 25 to 50% over roughly 1 to 2 weeks after a big run. And the climax run usually happens 18 weeks or longer after the breakout. So clearly you have to, I mean, another example, another lesson from Syntex is, find the right buy point and entry point, but also be ready to identify that climax top and when to get out to secure your profits.
Very well said there. All right, let's move on. And we were initially going to be taking a look at Pick and Save, but we're going to be looking at Price Club instead as our example. And as I pull up the chart, Dave, can you first talk about, because I mean, these are two retail names here, and retail was an area where Bill O'Neill found a lot of great trade ideas.
Exactly. With the help of Pick and Save and Price Club, the profits, which was in the millions of dollars back in 3-4 decades ago, Bill got the capital in order to fund the start of the newspaper Investors Business Daily in 1984. We're going to coming close to 40 years now with that newspaper and its related products. And here again, among the 7 principles, invest in what you know and can experience and feel. And so the founder of Price Club, Sol Price, his family immigrated from Europe initially to New York area. Then they moved to San Diego because Sol Price's father had tuberculosis. The doctor recommended go to a warmer climate, so that's how they landed in San Diego. And Sol was very well educated. He had a PhD. He had a bachelor's degree in philosophy, I believe. He started in retail and was very successful in discount retail. Eventually got pushed out of a company called FedMart, which was a discount retailer that served the federal employee market. Well, he came back and started his own Price Club company in 1975 with 1 store in San Diego. And he really revolutionized, sales and retail sales. He basically sold brand name goods at wholesale prices, cutting out the middleman. The first customers were small businesses, later federal employees, credit union employees, and then in the 1980s, Price Club, Sold Price was the first to open these kind of warehouse type of stores to the retail audience. That happened in the early 80s, and now today we have hundreds and hundreds of billions of dollars of warehouse club type of sales. What also made Sold Price and Price Club unique was that the stores had fewer than 3,000 items, not 25,000 or more like other stores. Company kept costs low by using word of mouth for advertising, and also didn't have any storage costs because they got the goods from manufacturers and directly put them into those stores, which were basically warehouses. So birth of an incredible company, 417% gain in 60 weeks. The initial breakout point, you can see, was really a double bottom base with a little handle. That handle was perhaps long enough to be kind of a base on its own. The price at that breakout was a lot higher than what you see. This is accounting for at least two stock splits. So please keep that in mind. And also, Ali, why don't we point out that turquoise line, that relative strength line. I mean, that was really incredible. Right below the
Sure.
chart. Yeah, the
Sorry, I was
price
unmuting
chart.
myself. Go
Oh, no
ahead.
worries. Yeah, you can see that while the stock made that base, that double bottom with two lows, and then a breakout point near, $9.50 on a split adjusted basis, that relative strength line was rising. And what that meant is that Price Club was outperforming the general market, the S&P 500. And as it broke out, it just kept going and kept going and kept going. So the lessons that we can get from Price Club is one, here is a relatively new company, but a great manager who really revolutionized, innovated. Two, you want to buy early. You want to buy these companies in the early stage of its overall cycle. And Bill O'Neill was fortunate, living in Los Angeles after coming from Oklahoma, going to school in Texas at SMU, serving in the Air Force in Alaska. He eventually decided to live and work in LA. Well, San Diego was a good place to, investigate what's going on that's interesting and new. And that this was such an important four-year investment. But he later said during seminars that he should have kept watching the stock because eventually Price Club made an even bigger move through the merger with another company that became Costco. Costco, we don't have time today, but if you look at a monthly chart of Costco, you'd be wowed by the magnificent performance of that, of that stock there. So
Right.
he would say, always be humble enough to look for that new opportunity in the same area, even though you've had a big success. Maybe you can capitalize even more based on your positive experience in a company like from Price Club to Costco.
Next, let's take a look at Amgen.
Mhm.
This is another big winner. And I'm trying to make sure I have the right one first because we have two charts here. I believe this is the correct one, Dave.
Yeah, there we go. Perfect. This is showing the early move, a company that was founded in the early 80s and then went public, as you can see. It came about during the golden age of biotech, as was when Genentech came out and recombinant DNA became a big thing. George Rathman was the co-founder of this company. He was a humble servant to his employees. He worked from a trailer so that his scientists would have more space in which to innovate. Incredibly, Ali, as everyone knows, most people know that Amgen is famous as a biotech providing therapeutics, but its initial mission was actually trying to find some real industrial applications to recombinant DNA, kind of adjusting, modifying, splicing genes within the human genome. And initially, they looked for solutions to extract oil from shale. Amgen tried to find a way to help chickens grow faster. And they even tried to produce indigo dye from E. coli. They eventually discovered that, well, you know what, maybe this technology can have some medical therapeutic uh, benefits. And eventually, with a strong uh, research team, they came upon cloning the erythropoietin gene, and that led to Epogen, their first major product in 1983. So this is before the stock made this giant move and breaking out of all those bases. This is so revolutionary. It helped cancer patients dealing with chemotherapy because those patients had low red blood cell count. Epogen helped solve that problem. Later, 2 years later, they came up with Neupogen to address patients who had very low white blood cell counts. FDA approved Neupogen in 1991, and it became Product of the Year according to Fortune magazine that same year. 1992, $1 billion in total sales, and then in January of 1992, joined the S&P 500. Before that happened, obviously, we can see that the stock was an early new company, early innovator in biotech, produced a lot of these big breakouts. And that initial run was a 681% gain over just under 2 years, 96 weeks. So up 681%, 96 weeks. And here again, you have a company that was also benefiting from a huge tailwind, which was the start of a secular bull market after the government was able to, with the help of the Fed, conquer inflation. The market turned in August 1982. You have more IPOs coming out. Applied Molecular Genetics, or Amgen, also went public. There was extreme interest among venture capital firms to find these new companies and make them public. Amgen was one of them. And so you can see that, yeah, there were some very, very big drops, but it goes to show how important it is to buy these companies early in their run, because you can see the pullbacks were generally a lot tamer.
Absolutely. And we have another Amgen screen that we want to show from this stock a little bit later on in the move. So here you can see the progression of the stock about a third of the way in from the left side is what we were showing previously. It went sideways for a little while, Dave, but then it started taking off again. So maybe if traders didn't catch that early move, they could have gotten other opportunities to get in.
Absolutely. It went sideways, and before that, it really had a big drop. Look at 1987, right? Black Monday, October 87. Well, Amgen was not even immune to that crisis, which was actually short-lived, and the market soon hit new highs relatively soon afterwards. But yeah, I mean, to go from a split adjusted price in the high sevens to the high twos, I mean, that was a tough time for the market. But it goes to show that the stocks that have the greatest fundamentals and the greatest products and the support of institutional investors can make their way back. And notice in the late 80s, and we're going to look at eBay in the same way. After that shock in the market, the stock continued to actually trade more tightly, form bases with lighter corrections from the high to low, and eventually start hitting new highs, trend higher, moving averages up, relative strength line going up. New products come in, growth is sustained, that double and triple digit growth. All of those things have to really work together in order to find these kind of Bill O'Neill type big winners.
And speaking of eBay, I want to leave us enough time to go over that one. So let's pivot to eBay.
Yeah.
How does it sound, Dave?
Oh,
Okay.
absolutely. I'll be very brief because I know we're a little bit limited on time. Just a few points. eBay started by Pierre Omidyar in 1995. It was originally called Auction Web. 7 years later, it became the number one e-commerce site in the world, partly due to mergers, partly because of its acquisition of PayPal. And the stock had a 282% gain in 114 weeks from the breakout. Now, this is a crazy looking chart here,
Yeah,
but
for those who aren't looking at what we're looking at, this is just sort of showing you inside the mind of Bill O'Neill with all of the annotations that he liked to make, pointing out various fundamental and technical aspects that he found notable.
exactly. Here again, we could have spent the whole webinar on just this chart alone. But from the right-hand panel or right-hand side of the chart, after eBay had this huge decline amid the 79% bear market decline of the Nasdaq, eBay eventually formed a double bottom base, broke out in the mid 60s. This was in late October 2002. Many people might remember that the bull market really started going in March 2003, but sometimes you're going to have these companies that break out ahead of the real bull market. Zoom Video is a good example. It actually broke out a couple weeks before the market bottomed in early March of 2020. So here, you have a lot of details regarding the earnings growth running at triple digit, sales growth also at high double digit before the move started in eBay. You have a company that already had a record of great growth, great management through Meg Whitman, and the very bottom very bottom part below all the fundamental data on a quarterly basis, you have the number examples of all these top performing mutual funds that establish new positions in the stock over time and continue to build upon these new positions. So I wish we had a little more time to really get into the nitty-gritty of this chart, but here again, I hope people can maybe take a snapshot of it and notice that there were multiple buy points after that breakout. So, always give yourself a chance. Don't let pride get in the way. If you didn't get it at that initial breakout, there was a 3 weeks tight. There was the base on base. There was a 10-week moving average bounce. These are all signals and rules that we've developed over the years and write about on a near daily basis. And as I said, it took a while, 114 weeks, but possibly a game-changing kind of gain if you have a concentrated position. So, if you only have 1% of your stock, your portfolio in something like eBay, even if it triples, it's not going to make an overall impact. That's why we really suggest, preparing for these kind of future winners at the start of big moves by examining, researching, looking at all the details, noticing the stock is stronger than most and poised to possibly even get stronger.
Well said, Dave. Before we wrap, we do want to get to a couple of audience questions. So let's go there. Greg is asking us to cover Bill's theory and practice of focusing dollars on his winners, exactly what you're saying, that concentration, making sure that if you have a big winner, it's going to move the needle in your portfolio. Greg is saying this seems to me like a high risk strategy, but likely a necessary one for significant gains. What's your take?
Yeah, Greg is right. There's high risk only if you don't limit your losses. And we have our 7% loss rule. And it doesn't matter what's the share price of the stock. It doesn't matter what's the size of that stock in your portfolio. If it's trading at 1,000 or if it's trading at $10 a share, we still use the 7% loss rule because it's much easier to recover that 7% loss with a 7.7% gain in the next stock. But if you take a 50% loss in a 10,000 investment, you're down from 10K to 5K. Well, you need a 100% gain in a stock to go back to break even. That's a lot harder to do. So it's really, it's not the share price. It's not, it's all about the size of your position and how well it's performing as soon as you buy it. You can always also sell more quickly if you sense that it's really breaking your expectation of a big move.
Yeah, risk management, so critical. And Sinclair is asking, how did William O'Neill scan for movers? What was his go-to way to find the stocks that he should be buying when they're breaking out?
We have some articles that detail how Bill started his business, and one of the keys was embracing technology, using an IBM mainframe in the early 60s to accumulate all the data that you see, for instance, in this eBay chart. It was not just the price and volume, but it was the fundamentals, return on equity, profit margins, uh, the stocks industry group. We have 197 industry groups, and you're going to have more success if you buy those stocks in the top industry groups, not in the bottom industry groups. Also, fund ownership. So, over time, he sold these data graphs, which is a great example you see right now with eBay, and just kept accumulating over decades this information. Before that, he also looked at the best performing fund managers and looked at their holdings and their buys and sells, and was able to determine these entry points and the key fundamental principles.
Yes. Also, Ken is asking, how have things changed now that Bill's secrets are known to so many?
Hasn't changed that much, frankly. I think the speed of the markets is faster, right? As an example, on the IBD live show, we talk a lot about great stocks that find support at the 21-day exponential moving average, which is a measure of the action over 21 days. It used to be that I think a lot of buy points were more at the 50-day or the 10-week moving average. At the same time, there are many people who don't want to buy a stock when it's at or near highs or at a high price to earnings ratio because they just don't believe that there's any room to grow. Well, we find that the market still is run on principles of earnings and fundamentals, and also greed and fear. And these stocks have a lot of momentum. You have to just appreciate and understand that that's also a profit opportunity.
Julie is asking, or wanting feedback on something she gets confused about. At IBD, we often say, don't chase an extended stock. You'll have plenty of opportunities to get in if it forms another base pattern, with the other thought of getting in heavy on that initial breakout is by far the best. And the later stage bases that you get are decreasingly positive.
Hmm.
What's your
Yes.
feedback for Julie?
Well, I think those are two great points. One is if you buy a stock way above that initial breakout, eventually the stock is going to succumb to some profit taking, and you could see even among many stocks a 20% gain go to break even, and you just don't want to be caught at the top of that little mini cycle. So we really hope that you just drop by as close as possible to that point where there's an obvious shift from supply for the stock and demand. Demand is coming in strong. Volume is heavy. Price action is great. Um, and in order to do that, it's really important to kind of stay in step with the market, kind of be ahead of the curve, because a lot of people are still disbelieving the current trend of the market. Watch the follow through day. We write about that frequently. And that's had a really good track record over the past century, noting those major market turns.
Yes. And there are so many great questions. I wish we had time to answer all of them, but make sure you follow Dave and I on Twitter at Saito Chung and at Alissa Coram to interact with us if you have more follow-up questions. But last one here, Carrie is asking about Bill's pyramiding. How did he pyramid into a rising stock? How much? How many times? And Bill really was the master of trading around a core position.
He was. He came very close to a 5% holding in Pick and Save back in the 60s and 70s. And in a workshop, he detailed on a weekly chart all his buys and sells and buys and sells, but he kept a core position which was close to the original breakout point. So, yes, you can manage your position around the fringes, but it's still very important to make sure, decide one, how much of my portfolio am I willing to put in a potential leader? Is it 1/10? Is it 1/8 of my portfolio, 1/6 even? And then make sure it doesn't fall 7%. Let it rise some, and then from there we look for those follow-on entry points. So a new base, a base on base, a pullback to that 10-week moving average. Those are the major keys. Always, when you pyramid up, that you buy a smaller amount of, you put a smaller amount of money versus the initial investment, because you don't want your overall average cost to rise too quickly, and you don't want a top-heavy type of investment. You want a pyramiding investment where the very last buy is the smallest chunk of your overall investment. And it can depend on the type of the stock. Some stocks will move much faster, so you might have to pyramid faster.